two more important aspects which seldom we talk about. Okay, and that's called liquidity. So when you buy a house, you're buying an asset which is great, which we just spoke about, taking a loan and buying an asset. Now, even if you paid that loan and you got the whole house for yourself, okay, the problem with an asset like a house is liquidity. There are no, you cannot go and sell that house tomorrow in the morning, okay, but you can do that with mutual funds. You can do that with stocks. You can do that with a lot of other asset classes. You decide and you can sell it the next day because these markets have liquidity, and what that means is there are buyers and sellers at any given point of time available to pay a ideal price for that. At the same time, in an illiquid asset like real estate, if you try and go to the market to sell a house immediately, the buyer will know that you're trying to sell a house immediately, and they're going to quote much lesser, and you may not be able to make much of it. So liquidity in any asset class is a key, feature which you may want to look at before investing. So lower the liquidity, greater the risk of getting an ideal price when you're trying to settle that. The other bit is divisibility. Now, life is not linear. Good things happen, bad things happen, and we may need money for those things. So, and we would want to, experience those things in life. So how do you do that? Sometimes you may have to sell your, part of your investments to kind of fund something. It could be a great event. It could be a travel. It could be something else that you want to buy. Okay. And again, comparing the idea of to help you understand the concept of divisibility. Now, if you have a house, you can't really sell your drawing room. That, hey, you know what, this year I want to go on a Europe tour, so I'll sell the drawing room and buy the drawing room back later. That's not possible. But that's possible if you have mutual funds, if you have gold. Again, a dematerialized gold is easy to sell, and so on. You can sell a part of what you have and fund whatever expenses that you want to. So divisibility of an asset class and liquidity and risk and return are all the different lenses through which you may want to look at it before deciding on which asset class to invest in. So let's assume that you figured it out. Okay, so you figured out that I'll put 50% of my money in equity. I'll put around 30%, in debt, and another 20% in golds. That's what you kind of figured out. Now that brings us to another question. To now, what happens is this particular mix of assets that you have got now, that's going to increase and decrease in its value. So gold may go up 1 year, the interest rates may go up, so your FD investments may go up 1 year, and in another year equity may give you bumper return. So all these go in cycles. So something or else would happen at a given point of time in a given year. Now, do you want to just leave it like that and forget about it? Okay. Or do you want to manage each of these things in a way better, way more active manner? Do you want to kind of figure out which are the best stocks which are doing well and invest only in those stocks? Or you just want to kind of buy an index fund, buy a bunch of blue chips and forget about it? Okay. Coming from the quantitative investing space, coming from the systematic investing space, um, my bias is towards active management. There are a lot of advantages to it, but then if you are a person who does not want to do anything with money and you just want to blindly put money off, then passive investing, which means looking at your investing maybe once in 6 months, once in a year, and that could be an approach which suits you. Okay, so, but these are both these approaches are there. Active has definitely far more advantages than passive, but to each his own, as they say. Okay, and then there's another aspect: discretionary versus systematic. Now, like with all things, we can health is a very good example when it comes to discretionary versus systematic. Okay, so are you a person who would want to follow a regime, go to the gym or wake up every day on time, walk or run, do things on time, measure how much food that you take? That's, you are then a systematic person. But if you want to be discretionary, you say, oh, okay, today I'll go for a walk, tomorrow no, today it's weekend, so I don't think I should be exercising today. And next weekend you may decide, no, I think this weekend I can exercise, all that. So that's a very discretionary approach. And both in investing as well, there are these two approaches. So there's discretionary approach, which humans, fund managers, try to take a decision based on processing that information. And then there are systematic, investing methods where we look at data, where we look at rules, rather than making a decision based on how we feel about something at a given point of time. We create rules, we follow data, we follow some sort of a systematic approach to investing. So again, as you would have figured out, obviously, I'm more for systematic investing than for any kind of discretionary investing or otherwise. Anything as any discretionary aspect in life is not something which I would personally prefer. Okay. So with that, so we spoke about say earning, saving, growing our money with investing, and so once you invested or and enough, once you have a substantial capital with you, what happens is it if that money reduces, so let's say you had zero savings and now you have, let's say, after a couple of years, you got some 10 lakhs that you saved. Now, even if it goes down by 10 or 20%, it becomes 8 lakhs, it's going to feel, you want to feel hurt that, oh shit, I just saw last month it was, 10 lakhs. And now when I open my, broking account, it looks like, you know, 2 lakhs have just vanished. I should have exited from the market. So all those things happen. Okay. Now, how do you deal with that? So this kind of is a complex area, not something which there's no one answer that fits everyone. There are simple methods which are called asset allocation, where you divide your money across different assets, something that we spoke about: gold, debt, real estate, to equity. And then you could use something even more complex called derivatives, which help you protect your wealth in bad times. It's a bit like insurance. We all buy insurance. Onsurity provides awesome insurance products. So likewise, derivatives are insurance products which are designed to save you from bad times. They can be used. There are multiple other uses, but they can also be used as insurance for your wealth. So that's about protecting wealth. Okay. So with that. I'll quickly get to the last part of this particular session, okay, which is about learning. Now, while we spoke about exploring, if you are in your under 30s and around that, it's a time where you typically tend to explore careers. It's also a great time to explore different types of investing strategies or approaches that suit your personality. So I wish really something, someone would have told me about different ways of investing when I was in my 20s. Okay. So I only knew, the only thing which I knew is buy a house or maybe put my money in a bank FD. Markets were not so accessible at that point of time. But today, I would say it's far more accessible, far more easy. So explore different types of investing which is possible, so that in the next 3 to 4 years, 5 years, when you're able to save more, you don't have to rely on experts. You don't have to take advice from a Sandeep to figure out what you want to do with your money. You would have figured that out way before the point where you have money to invest. So you would have figured it out yourself. It's not so complex. It's not rocket science, but it requires a bit of an effort, and you should be able to do that. And with the resources what are available today, it's very, very accessible. So learning about investing. So one thing is, think about equity as an asset class. It's a great asset class. You can do a lot with equity. You can diversify. If you think you want to put all your money in. If you think the future is all about, let's say, EV, electric vehicles, you can actually set aside some money there. If you think banks are going to do well, you can put your money in banks. Equity gives you so many opportunities in so many different ways. It doesn't matter. You can put your money any kind of a thing, and you also get to learn about different companies, what they're doing, and so on. The problem with being passive is, uh, it kind of encourages you not to think about your investments. And when you don't think about your investments, you don't learn about it. So the downside is that. Okay, so activity increases your learning. So when you are invested in a company, like let's say, I invested very early on in a company called Praj Limited, and I never knew what that company was about. It because my money was going down, I was losing my money every other day. I started researching about it. Okay, so though I may not have made money about it, but I learned this is an industry which makes XYZ. They make these products, and the reason it's going down is because the government has come up with some kind of a rule against which works against this company and so on. So in general, you learn about the economy, and also that helps you get better with understanding stocks and everything. So that's one. And more importantly, if you get a hang of what is systematic investing, these are kind of rules which work in your favor in relatively short span of times, like 6 months to 1 year, where if you follow these set of rules, you are going to make money. To give you an example of what those rules could be, some of these may seem extremely unintuitive, okay, which but they work. To give you an example, so there is one particular rule which says that if you buy into the best performing companies every month, so companies which are doing well, okay, and keep buying into the only companies which are doing well, over the long run, you're going to make more, substantially more returns than what, let's say, a passive investing would give you. So you may think something which has already gone up, why is it going to go up further? But somehow that seems to work. Okay, so you can't do the reverse. So which means if a company is going down, you don't. If you follow the reverse, which means I'll buy stocks which are gone down every month, and that doesn't seem to beat passive investing for some reason. Okay, so what I'm trying to say is systematic investing allows you to explore these different ideas, and some of them may be extremely unintuitive, but data is on our side when it comes to these things, and they seem to work. Okay, so how do I invest now? So one of the things, at investment, we we are very passionate about systematic ways of investing, and we figured out that the only way, it's kind of, they say scratching your own itch, where we wanted to make it easy for ourselves to invest in different scientific and data backed models. So we thought, okay, let's start building something, and we thought, why not make it open? Offer this kind of a product to the world. We wanted it for ourselves, but we thought, the world needs it too. So that's where we kind of created this product where there are like multiple systematic investing ideas and models which are available, and each of these models are offered by SEBI registered research analysts and so on. Uh, so have a look, download the app if it helps you. Okay. So that, and with that, that brings us to the end of the session. What we did today was we just spent a bit of time on what are the key building blocks or pillars of financial well-being. We're going to build a house, and we'll also do the interiors as we move forward. This is just the first session. Okay. So in the next session, which is on 4th of Jan 23, we are going to talk about capital markets. We'll deep dive into it. Okay. So that's pretty much from me. Thank you for your time. Open to questions. And yeah.
Superb. Thank you so much, Sandeep. I think that was really insightful. I request all the attendees to please put down your questions on the Q&A. And while you guys do that, I have some quick questions for you, Sandeep.
Sure, sure.
Number one, we haven't really sort of touched upon, side sources of income or other sources of income. A lot of people have been talking about it. What's your take on a side hustle or another source of income, considering
Perfect.
the whole moonlighting phase that we can past, and now
Yeah.
we've come to the layoff stage. I think this is
Yes, yes, yes. Awesome. So I think it's a very relevant question. The way I would look at it is one of the resources which is limited for us is time. Okay, so we only have so many hours in a day. Now we all want to maximize the number of hours that we have in a day. Okay, whether, and so let's assume. So let's take a case of someone who's under their 30s. So you are between 25 to 30, and how do you think about the side income? Now, with your limited time, you have an opportunity cost. So if you're already working somewhere, you can, if your company allows you to moonlight, you could do something. Do that if it allows you to explore a different career. Okay. Don't necessarily do that for money. Likewise, for markets, if you want to explore markets or some other ways of investing, do that with a focus to learn about it, because this is where we get to learn more. Don't optimize for income, optimize for learning, is how I would say. Okay. So I think the side hustle is a bit overdone thing. Okay. If you could become good at something, your market value by the time you're 25, 30 would be way more than what it would, what that side hustle would compensate you. But at the same time, not, as I said, uh, this is not about side hustle. This is about, are you learning, are you exploring, are you developing more skills which would keep you in good stead for future. That's how I would look
Amazing. Next question. What should people who don't talk about finance or want to know about finance or want to read about finance do? Because I think it's essential. So there
at.
has to
Yeah.
be something that they can do.
So if finance or money matters don't interest you, it's tricky, but because it's going to affect you whether you like it or not. You can't run away from managing money, so you would have to do that. There are a couple of risks which I do want to highlight. If you are completely off finance, which means you don't understand anything, the odds of someone else giving you advice which may not be correct for you increases. So that increases. That's something which you need to be aware of. So a minimum level of awareness in terms of what kind of products are good and bad is a must. So there's no two ways about it. For example, a lot of people invest in insurance products which are not really insurance products, but they could, they kind of bundle them as investing and insurance. All that together may not be ULIPs for that matter. Okay, may not be the greatest of investing products, but a lot of people who don't understand finance get sucked into it, and then they pay for it later. So some basic level of learning is important. Okay. Otherwise, find a trustworthy financial advisor. Very, very tough. Okay. So this is where you would have to work towards finding someone unbiased financial advisor for you. And that's these are the things which you would have to do, and keep things as simple as possible. Okay. So there are only a few things. Don't fall into this whole, don't fall for someone's profit, someone's promise to give you way better returns than anyone else. That does not happen. There's only so much that you can do. So if you are not into finance, be extra careful with anyone's advice. Okay. Double check, triple check, and so on before you take any decision, because the odds of you falling for wrong advice is greater. That's how I would, and keep things simple. Passive investing, maybe indexing. All these are kind of concepts which we'll talk about in future sessions. Those are the things which will be
Amazing. All right, we have a lot of questions that have
awesome.
flown in. We have Vikram asking, what are some data points you check personally before investing, and if there are any free online tools you can refer to?
Perfect. So Vikram, awesome question. Now, as I said, I skew towards systematic investing, and one of the fundamental rules of systematic investing is we would, in general terms, we would avoid individual stocks. So, in a sense, we don't really buy one stock. So we would buy a bunch of stocks. It could be 5, 10, 15, 20. But to diversify, to reduce our risk, we always buy five, as I said, a bunch of stocks. Okay, together. Now, so my question would be in terms of how do you figure out which bunch is better? Okay, so that, if you want to answer, there are two fundamental ways of doing that. One is called fundamental analysis. The other one is called quantitative or technical analysis. Okay, most of the systematic investors would lean towards the latter, which is quantitative approaches, which means we typically try to figure out which are the stocks which have been performing well. We would rank them with some sort of an algorithm and buy into those stocks. We don't really bother what that company is doing and why, because the way stock markets work is stocks go up way ahead of the news coming in. So news and all these things get factored in later. So you can't really go buy the news and then buy the stock. If you do that, you may not be able to benefit from the appreciation in the stock. So follow approaches. There are, you may want to kind of Google about things like momentum investing. All these will tell you quantitative rules to buy a bunch of stocks. So that's what I would recommend. There are other ways of investing as well. Okay, but my recommendation would be to go with something which is more systematic, and that's how we would go about it.
Right. Guys, I think we have a lot of questions. We might not be able to answer all.
Sure,
So please feel free to reach out to Sandeep via
sure,
LinkedIn.
sure.
We'll move on to the next question. We have Ashwini asking, what's your thoughts on investing in land?
Perfect. So, okay, so this is a great question, Ashwini. So, let's assume, what is a land actually? Land is a resource, okay? And who buys land? So, someone would buy a land to either build a house or would, buy a commercial land for some business, okay? Now, you would, if you, let's take both the examples, okay? So, you would buy land because you have surplus money to buy land, okay? And a businessman would buy a land, a business person, I'm sorry, would buy land because they expect they would be able to sell the goods that they manufacture on that particular land and make money out of it. So these are two fundamental reasons why someone would commercially buy land or would personally buy land. Okay, for both these things to happen, the first thing that has to happen in the economy is the economy has to be doing well. Okay, so if the economy is doing well, you have a good job, you have enough surplus money to buy the land. Okay, likewise, if the economy is doing well, and that increases the odds of this businessman to manufacture and sell goods. Okay, but each of these, as I said, are kind of second order effects. The stock market moves ahead way before the land prices would move. Okay, so that is one. The divisibility point, which I told you, you can't. I mean, if you have a very large tract of land, you can, still, break it into smaller pieces and sell. But if you have a smaller piece of land, you can't really easily divide it and sell it. Liquidity in land markets absolutely zero. Risk of occupation, is high because you never know, depends on the land, but someone may occupy your land and so on. So that could be, those are other risks with land. But that said, comparing land to let's say a built property like an apartment is any day is better, because in an apartment what happens is the land value is very less. There's a depreciation which happens on the built up property. That's not something which happens with land. So in that sense, it is a better choice. But net, I would skew towards capital markets. And even within capital markets, you can expose yourself to a product called REIT, which is through which you can expose yourself to reality sector as such. And yeah, that's possible.
Amazing. We have a very interesting question from
Mhm,
someone who's asking that, imagine you're 24 and you have 30,000 as your salary with only
mhm,
5,000 to invest per month. What would you do?
mhm. Okay, so if I have only 5,000 to invest per month, I would choose uh, three things. So what I would do is, one, I would take 2,000 rupees and put it in an index fund. Okay, I'll take 2,000 rupees and put it in a debt fund. So by doing that, I learn about two products: what is a equity index fund and what is a debt fund. And 1,000, I would play around in stock markets to figure out what direct investing is like, so that I'm willing to lose that 1,000. And if I make something good about it, great. But I'll figure out some systematic way of playing with that 1,000.
Amazing. We have Vikram again asking, Sandeep, how are the bags in investment different from small cases?
If you look at small case, the little that I understand about the product is you have like a whole lot of choices there you get in terms of different thematic baskets and so on, and the hundreds of choices that you get there to invest. Some of them are great, some of them may not be, some of them are thematic. I'm not sure. Okay, so our focus when it comes to building investment as a platform was, we wanted to make sure that all the models that we host on our platform are something that we are confident about. Okay, which means we would make sure we'll look at the historical data. We work closely with our research analysts to make sure that we offer systematic investing ideas that work. We do not offer something which is discretionary. We do not offer something about which there is no past. So we take an idea, run that idea on historical data, on years of historical data, and see how it would have performed in different good and bad market conditions. And if you're not confident about it, we just dump it. Only the stuff that we're confident about is what we kind of, host on the app. So in that sense, I think we're different.
All right. So we have one last question before we sort of close the
Sure.
webinar for today. It's Fenil asking, what should be the bifurcation below equity and debt in portfolio to
Mhm.
grow it at maybe say 10 to 12% per year? Disclaimer is that I want to retire at the age of 45, which is
Okay.
20 years from today.
Okay, I don't have a calculator with me right now to kind of give you the numbers, but the general rule in the market is, whatever is your age, you kind of subtract it from 100. And, let's say if you are 20 years old, you subtract it by 100, so you get 80. So 80% of all your savings should go into equity and 20% in debt. Okay. And you keep kind of balancing that. So every year you reduce your equity exposure because you're getting older, and you increase your debt exposure. That is one. So that's one general thumb rule. Okay. And otherwise there are a lot of calculators which will exactly give you this number in terms of retiring, okay, early. So what exactly? But just a last point before I let you know about this whole approach of retiring is do factor in inflation, because that's something which is going to hurt anyone more than anything else. So at any point of time that you retire, whatever money that you have should be able to cover inflation costs for the rest of your life. And our lifespans are only increasing. So you're going to live way more longer than what you would imagine. So do factor that in.
Right. Amazing. I think that sort of answers Fenil's questions. Thank you so much, Sandeep. I think that
Pleasure.
to the end of the Q&A as well. It was really elaborative and informative, and I would say that there were like very nice takeaways that I kind of took from this session. For me, something very big was someone who is like completely disinterested or not interested in finance. What this webinar made me feel or understand was it's so important to ponder over it, right? And
Yes,
even
yes.
without you having to open a book or go check out a webinar or meet another Sandeep to learn something, the easiest way to start off could be, like the 5,000 example that we took, right? Investing
Correct.
in small buckets, trying to study the market by investing, and,
Yes.
ideally not risking too much, but then still finding a way to learn in the easy way, right?
Correct.
I think that
Correct.
sort of makes so much sense to me. And
Mhm.
to all those who kind of put down so many questions, I want you to know that, we have never received so many questions in our previous webinars. So thanks to you, Sandeep, for making it so
Anytime, anytime,
interesting that people
anytime.
had so many questions today. And really looking forward to another session that will happen in
Absolutely.
the following weeks.
Absolutely.
Thank you so much once again to you and Investment for putting out this time and preparing such a wellness session for all of us. So
Thank you, Abhishek, and I really look forward to the next session. And for all of you whose questions have not been answered, feel free to connect with me on LinkedIn or write to me, at Sandeep at investment.club, and I'll try my best to answer each of your questions.
thank you so much, guys. And if you have missed out anything of today's session, you can go check it out on our YouTube channel. It will soon be uploaded, and you can go check out previous sessions over there. And if you like Wellness Wednesday with Onsurity, please put a thumbs up and tag us, talk about us on LinkedIn, and tell your colleagues and friends to join. Thank you so much, Sandeep, once again.
Thank
And have
you.
a great
All
day.
right. You too. You too. Thank you.